just about the rates story? Is it just about what's happening with treasuries? Or do you see a more fundamental shift, perhaps, in the way that investors are viewing certain key parts of the bond market, given what we now see in the equity markets, being with key drivers there like AI, technology, and everything else? What's the key driver here, one or two drivers, for what's happening with bond price action?
Yeah, I think it's a couple things. I think historically investors look to the bond market for diversification, to diversify that equity risk that's in their portfolio. They look for it as a source of stability. You can think of it as sort of a ballast in the portfolio. And then the final component is the income component, which is great most of the time. And then it's even better. It kind of cushions those drawdowns. And it's real nice to have that in the portfolio when things get a little choppy.
You know, Tony, Mike brings up an interesting point with regard to the behavioral finance, behavioral economic side of just how things have evolved for traders and investors. The most traditional kind of equity hedge out there for decades now has been the bond market, right? This idea that you allocate differently between certain risk assets and bond type assets to make sure that you're always in a risk profile that's appropriate for that particular investor or trader. I wonder if you could take us through a little bit about how you've seen that behavioral element evolve towards the bond space, given the idea that there are so many more complex products like what Mike manages over at TrueShares for defined outcome equity, uncapped buffer, and everything else. What exactly has been the investor sentiment like for the bond market? And is there still a role for just a straight stock bond allocation in this portfolio, or is everything just getting much more nuanced and complicated these days?
Well, it's definitely getting more nuanced, and I think that's actually what I would describe as the trend over the last 10 or 15 years. 15 years ago, I think most advisors would think about their asset allocation as some split between equity and fixed income. On the fixed income side, there was probably one solution, call it the AG, and they would probably spend more time developing out the equity side. That's actually what we have seen shift and change over the last few years, because all asset classes, even within fixed income, are not the same, right? There's quite a dispersion between returns and opportunities. And that's what we've seen sort of shift and kind of play out over the last few years, is advisors are being a bit more thoughtful because there is more opportunity in fixed income now that rates are no longer, close to zero. There's and then there's product opportunities, right? So there's emerging market debt, for example, is one of the top returning asset classes in the fixed income market this year. Is up well over 10, and that comes along with all those benefits of diversification, lower the overall risk in a client's portfolio. So that is kind of what we are seeing continually play out, is this more granular view of the fixed income exposures in clients' portfolios.
The nuance and the kind of, custom tailored approach is something that we've seen and discussed now with regard to the buffer side of things on the equity side. How far, Tony, are we away from seeing way more robust structured type products enter the fixed income ETF market? I mean, for me, back in my Wall Street days, structured products were almost exclusively pretty much geared towards fixed income, currency, and commodity type situations. And then they kind of evolved out to be a little bit more sophisticated on the equity side of things. But for bond investors, is there a next evolution, so to speak, for some of these types of products for bond ETF investors with regard to defined outcomes, and just how big of a market would that be?
Yeah, I mean, I think Mike could probably comment on this, and that probably is in the future. There's still a lot of white space, just even in the more straightforward traditional fixed income asset classes. Like there's a lot of talk, for example, private credit, right? I don't know if that is something you would necessarily refer to as plain vanilla, but there is a lot of interest in that subset of the fixed income asset class to be in an ETF wrapper for clients.
And Tony, one final point about that. If you do see the types of products that we have seen come out for fixed income, what exactly, as an ETF manager yourself, would you expect to be the next evolution for bond ETFs? What would you like to see out there, or what kind of things are you contemplating at BondBloxx with regard to what the next product could be, the next big thing in ETFs for bonds?
Yeah, I mean, there's still, like I said, a lot of white space, a lot of segments of the market that have not been delivered, and we're spending a lot of time on that. Private credit, as I mentioned, is an area that we're spending a lot of time on. We do have a private credit ETF product in the market now. We've got one in registration, but there's still plenty of room, even in the traditional asset classes and fixed income, to deliver access to.